So, what do the major mutual life insurance companies think about concepts such as infinite banking, bank on yourself, cash flow banking? When it comes to these concepts, they are great ways to utilize a dividend paying whole life insurance policy as a financing tool. When I think of the idea of infinite banking, really how it works is that it allows one to take control of, call it, the banking function in their life. Specifically, once I build up a pile of money in a whole life insurance policy, talking about the cash value, I can then access that cash value to take advantage of opportunities. I can borrow from the policy, use it to invest in real estate, my business, pay off debt, whatever it might be. And by going to that policy, I no longer have to go to a bank or a third-party institution and take a loan by their terms, paying it back at their pace, meaning the time frame they want me to repay it, the interest rate they want me to repay it. Now I set the terms, with the exception of the loan interest rate, which is set by the life insurance company and the product that I have. So my firm belief when it comes to the idea of infinite banking or banking on a whole life insurance policy, if we want to call it that, is really why would one not maximize the cash value first and foremost? Because if I've got a maximum cash value policy from start to finish, what our company does is maximize the upfront cash value and maximize the long-term cash value of a life insurance policy, and then show you how to use it as the years pass. So if you like the idea of infinite banking, bank on yourself, there's several names for this concept. Why would we simply not maximize the cash value first? Because what that does at the end of the day is what? It gives us more money to work with. We've got more working capital. We've got more money in cash value that we can then take advantage of opportunities. So when it comes to your four major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual, what are their thoughts or feelings on infinite banking? Because we sometimes hear opinions and comments and reasons why we should not go with a quality company that has a track record of delivering the strongest actual cash values. Keep in mind, I said actual, not illustrated, but actual cash values to policyholders. But then we sometimes hear we don't want to work with the major mutual companies because they do not support these concepts, such as banking on a whole life insurance policy, or they will not approve it. It's difficult to get through medical underwriting. So in this video, we are going to cover a lot of information regarding the four major mutual companies and concepts such as banking on a whole life insurance policy. Let's have some fun here. So when we look at this concept, bank on whole life, infinite banking, whatever we want to call it, what I'll begin with is this. We often hear this. Typically, it's from agents or from an individual looking to take out a whole life insurance policy who's interested in the idea of infinite banking. They prefer a major mutual company because they want the strongest quality. They want to see the most out of their money, but they're told or they hear, hey, I heard that the major mutual companies don't like infinite banking. Or we also have heard this, particularly in our training business from new agents that have entered the field, is they've heard that it's difficult to get a cash value life insurance policy approved with the major mutual companies specifically if you are purchasing it with the intent of practicing infinite banking, bank on yourself, again, whatever concept we want to call it. So there's your major mutual companies. Again, Mass, Guardian, New York Life, and Northwestern Mutual. And again, here's what I will reiterate. Is we have consistently seen them deliver among the highest cash values on whole life insurance policies, not illustrations, but actual performance. When we look at real policies that have lived the test of time, they deliver. And why I'm so big on that point is when it comes to the number one source of buyer's remorse with whole life insurance products is when someone takes out a whole life insurance policy. Their primary objective is cash value. That's why they're taking out the policy. The death benefit is important long-term, but they say, the cash value, Steve, that's what I want. Like, how do I maximize that? So the biggest source of buyer's remorse is when a policy is purchased for cash value, and then that cash value drastically underdelivers from what was projected on the illustration. So how you prevent that to the greatest degree is one, by properly designing a policy, minimum premium, maximum PUA allocation, and then two, selecting one of those four major mutual companies. We've consistently seen proof from them. That's where I come up with that statement. You can look at any of our historical performance videos on our channel or reach out to us and we can provide that proof, no problem. Now, I want to hit on some facts here that are very important. As the client, so if you're looking at a whole life insurance policy, you like this concept. You say, okay, I want a life insurance policy, but I heard that the company I prefer, one of the major mutuals, they don't really like the idea of infinite banking. Am I going to be restricted from being able to use my policy? The answer is no. When you look at facts, you've got a life insurance contract and you can do whatever that contract language states. Now, as you read through that contract language, regardless of what company you're reading the contract with, sometimes it will appear as if it contradicts itself, and that this is small and large companies. But at the end of the day, the contract language does state what you can and cannot do. A primary example is policy loans are available in the first year. If you have access to a loan, you have access to a policy loan. There's no literature from the major mutual companies that states that you cannot use a life insurance policy for this concept, the idea of infinite banking. However, literature does exist that promotes the idea of banking on a whole life insurance policy from the major mutual companies. We're going to reference a specific example at the end of this video. It'll be interesting. Let's continue on here. So here's a question that I would ask if I'm hearing information from a number of sources is I would simply ask, if I'm a consumer, do insurance companies have concerns with these concepts that promote using a cash value life insurance policy as a bank? And the answer is yes, there is a degree of concern. And really, this is due to lack of awareness more than anything else. And the primary concern is this. It's about the agent and what is being said in that meeting. Is that agent being completely transparent, providing all of the pros and cons, specifically when it comes to policy loans? Or are they pitching a whole life insurance policy as this wonderful alternative to a bank where you can just borrow from it, never pay it back, and you're never going to run out of money? Then the policy lapses and there's a big taxable event down the road. This is the kind of stuff that insurance companies are concerned about. That's one example. We're going to go through some examples of misinformation here. So here's some concerns. So I just blurted out one example there, but again, in purple there, you see the concern is about the agent and what is being said, specifically in client meetings. Misinformation is what insurance companies do not want. So when we look at misinformation, here's a couple examples. A dividend rate at 6% and a loan rate of 5%. Meaning you can take out a whole life insurance policy with a company that has a dividend interest rate of 6%, and then on that same policy, you have a loan rate of 5%. Think about that for a second. If I say, hey, you can put this money into a whole life insurance policy, you're going to earn a dividend of 6%, and you can borrow at 5%, what do you immediately think? We're going to come back to that in a little bit. Another example, excessive policy loans without repayments. This is a big concern. The reason why is if I take too many loans against a whole life insurance policy and that policy lapses, or I have taken more money from the policy than what I have paid in, that's where I will run into a taxable event down the road. And this is going to be income tax, not capital gains tax, if a policy lapses. So excessive policy loans without repayments is a concern because it can create a tax liability for a client when the client was told by the agent whole life insurance or cash value life insurance is tax-free. It grows tax-free. You can access it tax-free. Yes, that's true. However, there are instances that can occur and that have occurred with life insurance policies where people have had large tax liabilities where they were told that would not occur. This is where concern comes in from insurance companies. The last part, that can be difficult to get through underwriting, specifically financial underwriting, if I want to pay large dollar amounts into a whole life insurance policy. We'll hit on that. So the first bullet point here, the client hears you can start a whole life insurance policy and you have a dividend rate of 6% and a loan rate of 5%. So if that's you, what do you think when you hear that? Well, what most think is I've got a positive spread of 1%. If we were to rewind the clock to when dividend rates were a little bit higher, go back about 5 to 7 years, take Mass Mutual as an example. You saw a 7.1% dividend interest rate for 3 consecutive years. The loan interest rate was 5%. That's over a 2% positive spread, and it looked fantastic on the illustration. Now, would that remain constant forever? That 7.1% dividend versus a 5% cost to borrow, that 2.1% positive spread? No. But even when I look at it today, people see this and think, I've got a positive 1% spread on my money. However, the client soon realizes, often after they start a policy, wait a minute, I've got this 6% dividend rate, but when I look at my policy, it's growing by 4%. And that 4%, by the way, is 4% at best after I've been paying money into the policy for several years. Remember that you lose money in the beginning because I've got the negative internal rate of return with the cost of insurance. We want to reduce the premium as much as possible to maximize the upfront cash value. But what's the worst part about a whole life insurance policy? We talk about this frequently. The early years of a life insurance policy, where I'm going to have less money in cash value than what I've paid into the product. If it's designed with a true minimum premium, I should typically see somewhere between, call it 80 and 90% of my payment in cash value in the first year alone. So back to this point, this is you're paying money into a policy. You realize I'm not earning 6%, but I was told that the company's paying me a 6% dividend rate. I lost money in the beginning. I'm earning at best 4%. This wasn't pointed out when I first started, meaning I'm paying 5% in loan interest. At best, the policy is producing a 4% internal rate of return. That's not a positive 1% spread. That's a negative 1% spread. If that's you, how would you feel? People get upset over this. So now put yourself in the position of the insurance company, especially a larger life insurance company, a major mutual company with a solid reputation. Would you have a concern of more clients feeling like this over time? Yes. How can that be prevented? Well, good agents communicating things properly, just with respect to how whole life insurance works. If I'm focused on the cash value, internal rates of return, loan rates, net growth rate, what's the death benefit growth over time as well, transparency on everything. But very important here to provide clear information and clarity. That was one example of misinformation and where a concern sometimes comes up with the idea of infinite banking. Next, what do we see here? Excessive loans with no repayments. We hit on this one earlier. If a gain exists when the policy lapses, taxes may be due. An example here, let's assume that you paid in $100,000 into a life insurance policy. You've paid a total of $100,000. Your cash value has grown to $200,000. You take out from that policy $200,000, but you do it through loans, because if you take loans on a non-MEC policy, they are tax-free. You do not have to pay income tax when you take those loans out. So you paid in 100, you got 200 out, so you got twice as much money than what you paid into the policy out, and it's all tax-free. Now let's assume when you have that loan outstanding, the loan balance grows to $250,000 because you're not paying any of the loan interest in this example. When that policy lapses, let's assume that the loan balance is $250,000. The policy lapses. What would happen in that case is the IRS would look at it and say, okay, you paid in $100,000. When it lapsed, you pulled out $200,000. However, this unpaid loan interest will count against your cost basis as well. So the 1099 you receive is based on $250. So that means I paid in 100. I took out $250. What's the difference? $150,000. That's the taxable income you will receive a 1099 for that particular year. Now, does that happen much? No, it's very easy to prevent. Regular communication with your agent, and even just not taking out the max loans and not repaying anything. It's easy to prevent. We've got videos that provide more information on that. But has it happened in the past? Are companies concerned about it? This is where concern comes in. It's more so, again, about transparency, not providing misinformation or not leaving out important pieces that the client finds out after a policy lapses and they've got this huge tax bill when they were told that the cash value is tax-free as the years pass. Next piece, hard to get through underwriting. So this, I don't really understand when we hear this from individuals we work with. I think it is just misinformation, or maybe someone heard it from someone else who had worked with the company before. All companies have financial guidelines when it comes to underwriting. So we've got medical underwriting and financial underwriting, and whatever those guidelines are, regardless of how I'm using the life insurance policy, those are the guidelines. Like, I just have to make sure that when I'm applying for the policy and I start that policy, my finances fall within those guidelines, and I'm good to go. So that's just really having awareness upfront on the application from the agent, more so than anything else, and properly communicating that to the client. So another thing we've got here, additional concerns, responsible selling. So companies are concerned not just about getting business, but good business. They do not want headaches down the road. Spoke with an officer who I've known for several years at MassMutual. He's a really good guy, very knowledgeable. And he said a concern at MassMutual is specifically this verbiage here, responsible selling. They want to make sure that policies are not just being sold like the wild, wild west back in the old days of premium financing. Hey, it's free life insurance, just get this policy. And then there are lawsuits down the road. Like, no, we want it to be responsible. We want the client to be informed and aware of what they're getting, so no issues occur down the road, or minimal issues. Issues do pop up, right? No matter what field or what situation we're looking at, whether it's finance or just, maybe I'm buying food from the store, but they want to minimize headaches. And how you do that is, again, through responsible selling. This is really from the agent being informed themselves and then being fully transparent. Another concern that all insurance companies have, small and large here, is money laundering. Frequent premium and PUA payments, taking loans, paying loans back on a very, very frequent basis resembles money laundering patterns. So, not that using a policy frequently is a bad thing and a company's automatically going to think you're involved in money laundering. Let's get this guy right now and investigate him. No, they do look at the application that was submitted. They do have a method of doing background checks on everyone who applies for life insurance policies. But because the pattern of these concepts, bank on yourself, infinite banking, resemble that of money laundering, that does create some additional work for insurance carriers and the legal departments there. They're going to look into everything because they want to protect themselves naturally. Again, think if you're the life insurance company and you say, we do not want even one case of money laundering. We look at this and monitor it very, very closely. And then we've got a bunch of people that are not involved in money laundering, but how they use their policy, the patterns resemble those that are. What would you do in that particular situation? You want the business, but at the same time, you don't want headaches. Well, this is where responsible selling comes into play. We've had calls with the legal department of one insurance company before, just to go over all of this information. And sometimes they request additional information from the client. Documentation is sometimes required. Again, it goes back to the responsible selling, having a solid relationship with the client, and just being transparent with everything from the agent perspective and also the client when we're actually getting the information and submitting the policy. But that is an additional concern, just to provide some awareness here. Now, a lot of this material that we've gone through is training for agents, right? Training and information that agents are taught, that agents need to know. Agents need to be responsible for and providing transparency for their clients. So important to do that, because what happens if I'm not transparent about everything, me being in the business? You get a policy, you thought you could use it for purpose or for reasons A, B, and C, and it turns out you can't use it for reason C. And you're like, that's a big reason I bought the policy, Steve. You should have mentioned that from the beginning. Now you're frustrated. And you're not just frustrated with me, you're also frustrated with the life insurance company, right? And the life insurance companies are concerned about their reputation. Everyone in business is, or everyone in business should be for that matter. I'm extremely concerned about that. So again, all of this information is for agents, but here's an issue that sometimes occurs in the life insurance industry when we look at these different concepts. Again, the concepts of bank on yourself, infinite banking, bank on whole life, which you'll see where I came up with that name in a second. But here, the problem is agents will sometimes drag clients into this and state that you should not go with one of the major mutual companies and use the mentions that we mentioned earlier, such as the major mutual companies don't like or do not support infinite banking. Therefore, you want to go with a small to medium-sized company. I'm like, okay, when I hear that, I've got nothing against smaller companies at all, but I need a detailed reason, just like from the major mutuals, as to why. Because when I look at a cash value life insurance policy, my goal is to maximize the cash value, if that's why I want it, maximize the cash value, maximize the flexibility. This way I'm not committed to a big bill. For example, if I want the option of paying $100,000, I can commit to a minimum premium of $10K and pour in excess funds into PUAs at my discretion. But I see that strong track record of real performance from the major mutuals. So if you're going to recommend I go with a small to medium-sized company, like I need clarity on that, concrete reasons. And we have not gotten any over the years. No proof of actual performance. There's one company we're working with that's working on obtaining the data. But here are my thoughts around it. Major mutual companies, in short, deliver when policies are properly designed. When you look at who corporations use, when they specifically take out whole life insurance policies on their executives, guess who they're using first? Major mutual carriers. When you look at banks, banks are different. Banks do not use whole life insurance due to regulations. They'll use pure bank-owned life insurance products, but the carriers that are preferred are, guess who? The major mutual companies. When you look at the wealthy that are using whole life insurance policies, major mutual carriers, corporations. Now, here's a point to mention. You'll see it there, the fourth bullet point there. Major mutual companies pay the lowest commissions in the industry. And I've said this before, I have zero issue whatsoever with agents getting paid. That's how we drive our business here at Insurance Business Concepts. Like that's how we drive it through life insurance sales. However, my issue is this, to be very, very clear. If someone has a goal to take out a whole life insurance policy and they want maximum cash value, and they're told this policy is set up for your goals, meaning I said to you, agent, I want maximum cash value, you said it's set up properly, I'm going to think as the prospect of the client, okay, the policy is set up to be as strong as it can possibly be. And then only to find out after the fact, it could have been designed differently. I see, let's call it a policy with the same company, same product, same out of pocket on my end, but significantly more money. Like this is what causes pain for people right here. They feel almost as if they're taken advantage of. So they find out all this occurred, but the only difference there was the compensation was much higher for that policy that was originally sold. So why agents, in my opinion, sometimes get defensive here is because I don't think that there's anyone who has the intention to try and rip people off and make huge commissions. I think we learn to do things a certain way. That's what we do. And then when we find out a better way, if we're not used to doing that, like, hey, this is the way I've done it forever, I'd rather just stay with this. But peel yourself or take yourself out of your own shoes, put yourself in the consumer's shoes. They're interested in maximum cash value. You've got to be able to adapt and show them different options there. So important always to have a focus on them, the consumer, the consumer, the consumer. Quick example here before I just keep on rambling on. When I talk about the commissions are drastically different because they are. If you look at the major mutual companies, one example that is close to the lowest, Guardian, will top out. So if you're doing a lot of production with them, meaning you're putting a ton of business through them with respect to premium and PUA dollars on traditional life insurance products, they'll top out in the first year on premium, not PUA dollars, but on premium dollars at 85%. So for example, if you have a policy where you're paying in $100K per year and your premium is $10,000, you've got a PUA rider where you're paying another $90,000. Perhaps that's optional. You make it flexible so you're not obligated to $100K per year. The 85% is on what? The premium piece in the first year only. And then renewals occur beginning years 2 through 10, which are significantly less. Depends on the company. They typically average out at 5% per year. But as we continue on, we see limited pay products there pay less upfront, and there's some products that pay even less than that. But let's look at the traditional products. 85%. I don't want to mention any names here for smaller companies, but you'll see it range between 130 and 150% in the first year. Now, it does have to do with where that smaller company is contracted. There's rules just in the industry. If they solicit business or offer business in the state of New York, that's really what allows them to pay higher commission rates. The major mutual companies do. New York is a big market naturally. A lot of smaller companies elect not to participate in it, which gives them the ability to pay much higher compensation, which a lot of times people say, who cares from a consumer perspective? However, from an agent perspective, think of it, if on paper, or if you're told, hey, all things look similar over time, or I can make a lot more with a smaller company, which one would you rather sell here? I can sell the same product, but make 100, let's call it 30% over here instead of 85. Which one? Okay, so I'm not saying that people are bad for doing that, but based on the data, which ones have consistently delivered the strongest cash values to consumers, right? I want the proof, the data here. So shall we look at some proof? Going back to the idea of the concept, right? Bank on whole life, let's call it. You'll see exactly why I use that term in a second here. The idea of using a whole life insurance policy as your own bank. Do the major mutuals dislike it, or are they comfortable with it? And we don't want to go based on what we hear from others, but instead we want to go based on what we can see. Can we see any actual data? Let's take a look at some data here. So here is an illustration from one of the big four that just about everyone is familiar with, good old New York Life. So this is an illustration from them. And this is actually based on the sales concept within their illustration software called Bank on Whole Life. So let's just go through a couple pages here. And I want to hit on a couple important pieces. So as we go down here, what do we see? Whole life insurance or whole life policy gives you the death benefit protection you want for those you care about with a cash value that grows over time. What do we see here highlighted in yellow? The money your policy accumulates is yours to access through no hassle policy loans to help fund life's important events, such as we've got a number of events down there, right? Pretty interesting, pay for a wedding, paying down debt, whatever it might be. Again, major mutual company here. One of the biggest ones whose compliance department is quite, I don't want to say rigorous, but they're big on just doing everything properly. One of the biggest companies in the world. Here's how it works. So I'm not going to read all of this. Let's just look in what's highlighted in yellow. So being able to access your cash value, or this part's actually on the cash value growth. Cash value grows without paying income tax on that growth. Notice the way that that's written as well there. So with a cash value life insurance policy, the cash value technically grows tax deferred. However, you can access it tax-free if you don't trigger a modified endowment contract, if you take the funds out properly, if it doesn't lapse with a gain. When I say take the funds out properly, we can take withdrawals or we can take loans. We don't want to take withdrawals during the first 7 years because it can trigger a taxable event. If we withdraw more than our cost basis, it can trigger a taxable event. It's very easy to prevent a taxable event, right? Most agents know how to do this, no problem. But they won't say tax-free because there are cases that any life insurance policy with any company, there are cases where one can run into a taxable event. So that's why that verbiage is written in that specific way. What do we see here though? So that's talking about the growth. We can access it tax-free very easily, don't worry. Can access that cash value through a policy loan, which requires no approval process, no credit check, and carries a competitive interest rate. It does, especially with interest rates ticking up quite aggressively over the past several weeks or several months now, I should say. Next, we've got this entire section highlighted. Policy loans reduce your available cash surrender value and your death benefit. While you don't have to pay the loan back, it is recommended that you do repay the loan to restore the death benefit and build up the cash value so that you can borrow from your policy again when needed. So this part I like. While you don't have to pay the loan back, it is recommended. And it is. Often when people ask this question, what I do like to say is, when you take policy loans, they are optional to repay. In a case where you kind of have to pay it back, you don't. But if I take out the maximum loan and then I don't pay anything into the policy, I've drained my cash value completely. I'm not paying any premium. I'm not paying any loan interest. That's a situation where the policy could easily lapse. If I'm paying premiums or anything, I typically don't have to worry about it, or if I'm paying it back. But if it lapses there, that's where a taxable event can occur. So they're correct in their verbiage here, in the sense that I don't have to pay it back. I could let it lapse if I take an extreme scenario, but it's optional to pay it back. It is recommended if you're using the policy. So if you said, hey, I'm interested in a whole life insurance policy, I want maximum cash value, I want to use this really to be my own bank. If I look at this concept here, can I do that? The answer is yes, right? You absolutely can. With policy loans, you can pay it back. You do not have to pay them back. I would recommend it while you are using the policy. Once you hit retirement, if your plan or you have an intention to take income from this life insurance policy, obviously you don't want to pay anything back because you're taking income. That would be counterproductive to pay money while you're taking money. At that point in time, we'll look at different assumptions based on the present dividend rate, conservative dividend, even guarantees, and see what things look like with income coming to you, tax-free from the policy, and not paying anything back, looking at all scenarios there, even a worst case scenario. But then repaying loans allows you to build the cash value up so you can borrow from your policy again. I emphasize that just because a good friend of mine brought something up to me not too long ago that someone was really, I don't want to say grilling him, but saying it's borrow against, borrow against. You can't say borrow from. Insurance companies use the verbiage interchangeably. That's all I have to say on that. Like, it all means the same thing. I can walk to the store or I can get there on foot. Like, I'm getting there the same way. Like, anyway, here's a quick sample of using your policy, right? So I just ran quick examples here, taking $10,000 loans. We'd have the full illustration here as well from the insurance company. There's the loan amount. They're quite creative here as far as what we want to use it for. And then you see what the values look like. What I love doing when it comes to policy loans is showing what the policy looks like when you take loans. And then if you pay it back, don't pay it back, pay interest only, different what if scenarios. And this is something that as a company, we do for everyone we work with whenever they're looking at policy loans. Unless someone says, I'm paying this thing back, that's the only option I want to see. I'm going to pay it back over the next 12 months. All right, we'll keep it simple and show you just that. But aside from that, I think it's extremely valuable to see the different options in the event life happens. I can't pay it back at the pace I thought I could. I don't pay it back at all. What's the impact of my policy? This way I've got transparency there and I don't run into some surprise down the road where I've got to pay taxes all of a sudden. Like, that's not why I got this. Let's continue on here. This part I like. Life insurance made for living. I like that. All right, so let's continue on here. You can borrow money from the bank. Yes, you can. Or you can borrow money from yourself. Borrow from yourself. Bank loan, policy loan. Going through the differences. With a bank loan, what do you see first? Approval process. Policy loan, no approval process. Bank, possible denial. Policy loan cannot be turned down. And several bullet points here. Look at the second to last one. With a bank, may have some fees, might not, depending on what the loan for that you're getting with the bank is. With a life insurance policy, no fees, assuming policy premiums are paid. And this is specific to New York Life. Some companies will have fees with premiums, or if you're reinstating your policy, you've got a late fee for the years that were not paid. Fees can be associated. It's rare if you're paying things on time and such. But it is possible. Same thing if you paid monthly or something like that. Over here, must be paid back in a specific time frame. That's specifically with a bank. Over here, no fixed payment plan. point to all of this. Do the major mutual companies dislike or are very, very against the idea of banking on a whole life insurance policy? Cash flow banking, infinite banking, bank on whole life, whatever it might be, or bank on yourself. We've got it in writing for them, concepts on their compliant approved illustration software. There are concerns that you'll hear in training meetings as an agent, as you work with companies. However, from the client, here's how I would look at it. Contract language states what you can and cannot do. And this is with respect to loans and repayments. It's also true when it comes to PUA payments. How frequently do you want to add PUAs? Some companies are very flexible, some companies are not. So whatever is in the contract language states what you can and cannot do. We've got a lot of examples of different companies and products that demonstrate what is and is not possible. But in summary, as far as the major mutual companies, in my opinion, they are the top four when it comes to policies designed for maximum cash value because of the actual proof we have, not just illustrations, but actual proof. And then regardless of what you want to use it for, if it's infinite banking, you can easily use it for that, as long as you've got full transparency on what you can do, what you cannot do, and what can go south, right, with the taxable events and such. So I hope this video was helpful and informative. If you have any questions, please feel free to leave them in the comments below. I do look at them. And if you enjoyed it, please hit the like button, subscribe for more. And as always, I hope this helps. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.